Hi friends, welcome to my YouTube channel FinWings Keep Flying with the Wing of Finance. I am here, your friend CA Sushant Singh, bringing you a treasury of finance knowledge. Okay, so we are here now about all about mutual funds part 2. Debt funds. So what are debt funds? Debt funds are the mutual funds that invest in fixed income securities like bonds and treasury bills. Gilt funds, monthly income plans, liquid funds, fixed maturity plans are some of the investment options in debt funds. Basically, what is this debt funds are doing? Debt funds are nothing, they are just lending your money. These bonds and treasury bills are fixed income securities. So what is fixed income securities? Fixed income securities are those securities which provides you a fixed and stable source of income, and this income is generated through bonds and treasury bills. These bonds and treasury bills are nothing, these are essentially a loan which you are lending to a corporate or a government organization. For instance, here T bills is treasury bills. Treasury bills are those bills which are these are those securities which are issued by the government, and essentially what we are doing is that we are lending to the government the money, and against that we are getting an interest income. As these bills are issued by government, so these are default risk free. That is, the government does not default on the interest and the principal payment. Now we come to category of debt schemes. Now there are plenty of category of debt schemes. One of the schemes are overnight funds. It is an open-ended debt scheme investing in overnight securities. These are the securities which are having a maturity of 1 day, as the name suggests, overnight. So these are the securities which have a maturity of only 1 day. These are essentially an interbank lending where the one bank lends to another bank in order to match their assets and liabilities on a day-to-day basis. Liquid funds. It invests in highly liquid money market instruments and debt securities of very short tenure and hence provide liquidity. They also invest in treasury bills, commercial papers, certificate of deposits, and these securities have a maturity of up to 91 days only. Whereas in case of overnight, the maturity was 1 day. In liquid funds, these securities have a maturity of up to 91 days. So as I have mentioned earlier, that T-bills are the securities which are issued by government and they are essentially free of any credit risk. Commercial papers, these are issued by corporates who have a high mm, who have a good credit worthiness. Certificate of deposits, these are issued by banks. Ultra short term debt funds. Ultra short duration schemes are open ended debt schemes investing in instruments with a macular duration between 3 months and 6 months. Now, what do you mean by macular duration? Now, macular duration is one of the metrics which estimates how many years it will take for an investor to be repaid the bond's price by its total cash flows. Means here we are estimating the length of time it will take foreign investors to be repaid the bond price by its total cash flows. Cash flows means here the interest income and the principal amount. Now, what is a money market mutual fund? As the name suggests, money market. So these are the funds which invest in money market instruments, and these instruments have a maturity of up to 1 year. And money market instruments can be your treasury bills, certificate of deposits, repos, and commercial papers. Repos are nothing, these are repurchase agreements. Gilt funds. Now, these are the funds which invest in government securities across the maturity. As these funds do not carry credit risk, that is default risk, but do carry interest rate risks. Now, what happened When the RBI starts lowering interest rates, demand for previously issued government securities rises due to their higher interest rates. When demand rises, their prices also rise, and as well as the yields, and yields fall. Price will rise and yield will fall. As the demand for these bonds would rise, so the price would also be rise. Demand would be more than supply, so here the law of demand would work. Market demand and supply would work, and the price would rise and the yield would fall. So here one of the things needs to be remembered is that there is an inverse relationship between bond price and yield. As the bond price goes up, the yield goes down, and when the bond price falls, yield goes up. The opposite trend will occur when the RBI pauses or begins raising policy rates. Now, as the RBI has raised the policy rates, now the new bonds would have a higher interest rates. Now, what would happen to the older bonds? The older bonds demand would decrease, or the traders will start selling them. As a result, what would happen for the price of older bonds? Their prices would start decreasing, and the yields will start increase. Now there are certain other schemes which are index fund. Index funds are the investment funds that follow a particular benchmark index such as Nifty 50 or Sensex 30. When the investor puts money in this fund, that cash is then used to invest in all the companies that make up a particular index. As these funds mimic or mirror the benchmark index, so these funds are a passive fund. Here the fund manager style is of a passive, and here the fund manager is not directly engaged, not directly active, not actively engaged in managing the fund. ETF. What do you mean by ETF? ETF stands for Exchange Traded Fund. ETF is a fund that trades on an exchange, just like a stock. As a stock is bought and sold in the stock exchange, just like similarly ETF, it is the fund which trades on an exchange. It is also listed on the exchange and traded on an exchange, and it replicates the portfolio and performance of a publicly available index. It is a basket of stocks that reflects the composition of index like Sensex or Nifty. So here I have given a difference between the ETF and index fund so that um, um, investors might not be confused with the difference between the ETF and index fund. What are index fund and what is the difference between index and index fund and ETF fund? Now, ETF are closed-ended funds, whereas index funds are open-ended. In case of an ETF, you cannot invest by SIP, but whereas in case of an index fund, you can invest by SIP route, that is systematic investment planning. ETF has a low expense ratio as compared to the index fund. Index fund has a high expense ratio. ETF. In case of an ETS, in case of an ETF, holding compulsory in a demat form. That is, you need to have an account you need to have a trading account and a demat account for holding it. But whereas in case of an index fund, there is no as such requirement to have a demat account. You can have a demat account or you don't. If you do not have also a demat account, then also you can invest in index fund. But whereas in if you want to invest in ETF fund, then demat account is required. ETFs are like stocks, as we have mentioned earlier, so where the prices changes on a continuous real-time basis. Here ETFs prices goes on changing continuously on a real-time basis because it is trading on exchanges. But whereas NAV of an index funds are priced only at the end of the day like any other mutual fund scheme and not on a continuous basis. So these are the differences between ETF and index fund. I hope so that now the investors would not be confused between ETF and index fund. Tracking error. Now, tracking error is simply the difference between the scheme's returns and that of a benchmark return. This measures how closely a mutual fund scheme replicates the returns of the identified benchmark. Larger the deviation from its benchmark returns, higher the tracking error a scheme is said to have. It is simply the difference between what the mutual fund scheme has, what the mutual fund schemes has generated the returns and what the benchmark index like Sensex 30 or Nifty 50 has given us returns. And wherever would be the difference, that difference would be termed as tracking error. NAV. NAV stands for net asset value. It is the market value of the investment minus liabilities divided by the number of units outstanding. It is the price per unit. It is the price at which mutual fund units are purchased and sold. Okay, so these were the series of all about mutual fund. This was the last series of about all about mutual funds part 2. So please, if you like the video, you can like, share and subscribe to my channel. So here I say goodbye to my friends. If you have any queries or any suggestions or questions, please comment on the below. So bye bye. Fin wings keep flying with the wing of finance.